Welcome to my channel. In today's video, I'm going to cover some crucial insights about interest rate cuts, something which is going to be which is going to be helpful to you. We're going to cover interest rate cuts, why they happen, how they impact the economy, and most importantly, what this means for you as an investor. I'm here to provide you with some practical information that can help you make informed decisions in your financial journey. And be sure to stay with me till the end, where I will reveal the sectors most likely to benefit from the upcoming rate cuts, valuable insights which you don't want to miss. So, let's understand some basics before we discuss further concepts in this video. First, let's look at what are interest rates. Interest rates are essentially the cost of borrowing money. So, when you take out a loan, whether it's a mortgage or a car loan or even credit card debt, the interest rate determines how much extra you will pay back to the lender on top of the borrowed amount. So, the federal funds rate set by the central bank of your respective country influences these rates across the economy of the country. So, let's discuss the role of central banks. So central banks, for example, the Federal Reserve in the US, they are responsible for managing a country's monetary policy. So they adjust interest rates to control inflation, manage employment levels, and keep the economy stable. So when the economy slows down, they might lower the interest rate to encourage spending and borrowing. So to understand the borrowing and spending cycles, let's understand the economic cycle at large. So the economic cycle goes through four phases. The first phase is the growth phase. Then there's a peaking of the growth at the peak phase. Then it's followed by a slowdown called recession. And then there is a recovery. So understanding these phases helps us to understand why central banks might lower or raise interest rates at different times. For example, during a recession, lower rates can help kickstart economic activity. Let's discuss the difference between inflation and deflation. So inflation is when prices for goods and services rise and therefore they reduce the purchasing power of your savings. Deflation, on the other hand, is when prices fall, which might sound good to you as a consumer, but can lead to reduced economic activity and job losses. Therefore, central banks use interest rates to help keep inflation in check as well as avoid deflation. So they balance between the two. Interest rates directly affect how much it costs to borrow money, like homes, cars, or education. But the lower interest rates can make loans cheaper, which can boost spending, while higher interest rates tend to slow down borrowing and spending. So that's how the central banks manage the economic cycles. They respond to the economic cycles and they facilitate consumer spending and borrowing. Now that we have covered the basics, let's dive into understanding what an interest rate cut actually is. You have been hearing it a lot in the recent news about interest rate cuts and the Fed delaying or advancing the decision of interest rate cut, etc. So let's try to understand what interest rate cut actually means. So in simple terms, interest rate cut is when a central bank like the Federal Reserve in the US or the RBI in India decides to lower the interest rate at which banks borrow money. So that's the simple definition. So when the interest rate, or often referred to as federal funds rate in the financial lingo, when the interest rate influences the rates that banks charge their consumers and the businesses for loans, mortgages, and other financial products, that's when it influences the economy at large. So when the central bank cuts this rate, it essentially makes borrowing cheaper. That's the bottom line. And that encourages both consumers and businesses to take out loans and spend money or invest. This can particularly be crucial in times of economic slowdown, where stimulating economic activity is definitely necessary, and that is done to avoid recession going into a deep recession. So when the interest rate is being cut by the central banks, it's not an arbitrary decision. Central banks consider a wide range of economic indicators, one of them being inflation, and the other one being unemployment levels and the overall economic growth measured in GDP before deciding to lower rates. So the goal is often to strike a balance between encouraging economic activity and preventing runaway inflation. Now, both of them can occur, but it occurs only when if there is too much money, and that too much money chases too few goods and services. So central banks cut rates for several reasons. So let's understand in this section on how and why the central bank cuts rates. So the most common reason for a central bank to cut rate is to combat economic slowdown or recession. So during the period of recession, consumer spending typically declines, businesses pull back on investments, and unemployment rises. So lowering interest rates can help reverse these trends. And how does that reverse the trend? When the Fed lowers the interest rates, it becomes cheaper to borrow money, and therefore that encourages spending, investment, and economic growth. So when we look at history, interest rates have been cut as a tool to manage economic crises. For instance, during the 2008 financial crisis, central banks around the world slashed interest rates almost to near zero in an effort to stabilize the global economy. These cuts were definitely necessary at that particular time and were definitely instrumental in preventing a deeper depression and eventually helped to kickstart the recovery process. However, the timing and magnitude of rate cuts are crucial. If it's too little, the economy might continue to falter, and if it's too much, that if the central bank or the Federal Reserve cuts the interest rates too much, it might lead to excessive inflation or asset bubbles. So now that we have a fair bit of understanding about interest rates, economic cycles, and the role of central banks, let's understand on how the interest rate cuts or increases can impact the economy. The impact of lower interest rates can definitely be profound. For consumers, lower interest rates could mean cheaper mortgages, cheaper car loans, cheaper credit card debt, etc. And this can lead to increasing consumer spending, which is definitely a key driver of the economic growth. And for businesses, lower borrowing costs can make it easier for financial expansion. They can take in more projects, invest in newer technologies, hire more workers, purchase more buildings or merchandise, inventory, etc. However, there's a flip side which we need to understand. That is, when lower interest rates, they are meant to stimulate spending and investments, they also can lead to risk if they are not managed carefully. For instance, prolonged periods of lower interest rates can encourage excessive borrowing and leading to unsustainable debt levels. And additionally, lower rates can fuel asset bubbles as seen in the housing market just before the 2008 crisis. You can Google it if you want to know more. So then investors might also seek riskier assets in search of higher returns, which can destabilize financial markets. It's a delicate balance that the central banks must maintain to ensure the economic stability. Now let's understand the interest rate cuts in the economic cycle, or where the interest rate cut falls in the economic cycle. Interest rate cuts are a crucial part of any economic cycle, irrespective of which country it is or which financial ecosystem we are considering. So they are particularly driven by phases of they are particularly driven during the phases of recession and recovery. So in a recession, economic activity contracts, and that leads to higher unemployment and lower consumer spending. And then central banks, as a response to this, they cut interest rates to stimulate growth. So as the economy recovers and enters a phase of expansion, rates may gradually increase to prevent overheating, essentially to prevent inflation, basically. And this understanding is where we can analyze on where interest rate cuts fits in the economic cycle. So if you understand this phase, that is when interest rates are going to get cut, they're usually in the recession to recovery phase. So you can make informed financial decisions. For instance, during a recession, lower interest rates might present opportunities for refinancing a mortgage if you have one, or investing in the stock market, where lower borrowing costs can lead to rising asset prices. And conversely, like when during periods of economic expansion, when the central banks raise interest rates in response to the economic growth, that might signal the need to lock in fixed rates on loans or to be cautious with high risk investments such as borrowing becomes more expensive during that time. Another important concept to understand when discussing interest rates and economic health is the inverted yield curve. So typically longer term bonds have higher yield rates than shorter term bonds, and that reflects a higher risk over a longer term, meaning the longer time period, and that's normal. However, when the yield curve inverts, short term rates are higher than the long term rates, and that often signals that investors are worried about the near term economic outlook. Historically, an inverted yield curve has always, not always, but most of the times, has been a reliable predictor of recessions. So when investors expect slower growth or economic trouble ahead, they tend to seek safety in longer term bonds, driving down their yields relative to the shorter term bonds. So central banks, they closely monitor the yield curve because it can indicate an underlying economic stress. So as an investor, if the yield curve inverts and a recession seems likely, the investors move their money from longer term bonds to shorter term bonds, and the central bank responds by cutting interest rates to stimulate the economy and preventing a downturn. I want to talk about certain common misconceptions about interest rate cuts. And there are several misconceptions about interest rate cuts, but the ones that are worth addressing are: one common belief is that cutting rates always leads to inflation. While it's true that lower rates can increase, discretionary spending or inflationary pressures, the relationship is not so straightforward. Inflation is influenced by many factors, including global supply chains, consumer demand, geopolitical tensions, and fiscal policies of various nations working together. In some cases, rate cuts are necessary to prevent deflation rather than inflation, and that is a more dangerous economic condition when prices fall and economic activity, comes to a grinding halt. And another misconception of interest is that interest rate cuts only benefit large corporations or wealthy investors. This is not true. In reality, lower interest rates can provide relief for ordinary consumers by reducing the cost of mortgages, auto loans, credit card debt, and various other types of loans. Small businesses, which are often the backbone of the economy in most countries, also benefit from lower borrowing costs, enabling them to invest in growth and create jobs. So in this way, we need to understand on what the misconceptions are and demystify it, so that when we as investors go out and put our money into the market, we are able to take rational, informed decisions. So this is the section all of you might be waiting for, the bonus section where I talk about the sectors that benefit from interest rate cuts. So understanding this can help you make more informed investment decisions, and that's been my motto of this video, and you can take advantages of opportunities in the market. The first sector, which is probably going to benefit the most, is the real estate sector. Lower interest rates can typically lead to lower mortgage rates, which can boost demand for housing, and this benefits the real estate sector, including home builders and REITs, real estate investments trusts. The next sector is consumer discretionary. When borrowing becomes cheaper, consumers are more likely to spend on big ticket items like cars, electronics, home improvements, etc. And this can boost companies in the consumer discretionary sector to do well and increase their revenues. The next sector is the financial sector, that is the banks and the financial institutions. Banks and financial institutions may see mixed impacts, but overall lower rates can stimulate loan growth, benefiting sectors like consumer finance and mortgage lenders, because loans and lending is the main revenue driver for banks and financial institutions. And lastly, the utilities and high dividend stocks. Lower interest rates often make dividend paying stocks more attractive, particularly in the utilities sector, which offers the stable returns. So keep an eye on these sectors as interest rates change and consider how they fit into your overall investment strategy and portfolio. As always, do your research and consult with a financial advisor to curate or tailor your approach to your specific needs. So, as we move into a period where interest rate cuts are becoming more likely, with all the news and all the pomp around it, it's important to understand their implications for both the economy and your personal finances. So by staying informed and proactive, you can take advantages of all the opportunities that the interest rate cuts will present.